Now, on this series, we will be talking all about mutual fund investing and how you can really tailor a strategy to fit all of your personal needs. So we're really going to break it down. What is the approach and strategy that you should look at, during times like this, times of market volatility, when we're in a rising interest rate scenario, and of course, when all of these global macro risks are at play as well. In fact, when we asked all of our viewers for any queries that they want answered from the mutual fund space, a large chunk of them were exactly on this, that what should you do at a time like this when things are so shaky? So Sonal, I guess that throws up a lot of questions for our first guest today.
Oh yes, it does. And that's exactly what we are going to be talking about today as well on the show, right? So Pavitra, we have spoken about a lot that is happening. Investors are asking what should they do, which mutual fund should they buy in the current rising rate scenario. So that is going to be the first question that we are going to answer. And in this scenario, when we are seeing that interest rate change, do mutual fund investments really need that strategy change? And for that, we'll of course get in a guest as well. We have Mohit Gang, who's joining us now, who is the CEO and founder of Moneyfront as well. And Mohit, we'll get you in as well, and thanks a lot for joining us today. That is of course the first question, right? What to do in current scenario when interest rates are rising, especially for mutual fund investors?
Hi, Pavitra and Sonal. Good to be a part of this show. Look, so I think the times in which we are living are unprecedented in many ways, right? We have seen a rate hike of almost 190 bips in last 6 months. From the month of May till date, the repo rates have gone up from 4% to 5.9%. This is unprecedented hike in such a quick time, right? And now what has happened is, because of this rate hike, the transmission of this rate increase has not yet happened to that kind of degree and extent. The corporate borrowing rates, the individual home loan rates, they've all gone up, but not to a massive extent thus far, right? Even the deposit rates at which you book your fixed deposits, they've gone up dramatically, but they haven't gone with a very sharp pace and magnitude. So the times are changing, and they are changing thick and fast. Very soon, within next 6 months from here on, we will see the interest rate scenario really hurting each and every aspect of the economy, including the corporate borrowing and the individual borrowings as well, right? So we have to be well prepared to take action accordingly. Given this genesis and given this backdrop, my first viewpoint here is that each investor has to go back to the drawing board and look at the asset allocation once again. If you had decided that your debt equity allocation was, let's say, 40 debt and 60 equity, and for last 1 or 2 years debt hasn't given that kind of returns, and the equity portion has done reasonably well, and suppose, let's say, the equity is now back to 67% by virtue of market movements, then the investors have to actually take action and trim down that 7% additional equity allocation and move back to debt, right? This activity is fairly important, should be done at least 2 times a year. But this being the closer, we are closing towards the calendar year now. So it's better that all investors go back to the drawing board, do this asset allocation, get it right. And it's better to err on the side of caution here. I would rather recommend that you take a cautious view of equity, trim down your equity allocations, depending on your asset allocation. Again, I'm not saying go heavily underweight equities, but I'm just saying that get it right and don't go overboard right now, given the rate scenario and given everything else.
All right, so take a slightly cautious view, and you do need to sort of rebalance your portfolio to see if there's been any change in the debt equity kind of standing, and you can adjust that. Mohit, but that sort of leads me to my next question. A lot of viewers have also written in asking that what is the correct debt equity mix? Now, we know that there can't really be a one-size-fits-all approach, right? It just doesn't work like that. But how would you recommend someone understand their own debt equity mix, the kind that they would be comfortable with?
Pavitra, this is a tough one. To be very honest, there's no one size fit all answer out here. The debt equity allocation or the asset allocation is actually very, very individual centric. It's very essential to understand the conditions and the environment of an individual, of an investor, and then kind of recommend it, right? I can't have a team playing a cricket match with a 6-baller formation and a 4-batsman formation until I know the pitch conditions. And I can't get it right if I know whether I have to play the spinners or I have to play the fast bowlers, right? And it's being the time of Cricket World Cup, I'm getting in a cricket analogy out here. But the whole thing is, absolutely individual centric, depending on the risk appetite of each individual and their personal conditions. What are their goals? What are their liabilities? What is their cash flow situation? What are the family conditions? Everything else. What is the overall net worth? What is the kind of liquidity they want to keep? Do they have short-term goals? Can they bear volatility? All these factors put into consideration will come into play when you determine an asset allocation. So to be honest, I can't give a very generic answer out here for everyone, but all I can say is you go back, revisit the asset allocation, determine what was your actual debt equity allocation when you started, let's say a year back, 2 years back, and every year when you reassess this thing, and then delve into this and get it right. Now, one more thing which I can just say, let's say if you are in a scenario where you don't have any liabilities, you don't have any short-term allocations to be done, you are absolutely putting in monies for very, very long term for your retirement and wealth creation, then perhaps you can go with a 20-80 or a 30-70 kind of an allocation favoring equities, because finally, given the rate scenario and given the inflation, equities is the only asset class which will keep beating that inflation hurdle for you in terms of delivering returns. So you will have to believe in that asset class more so, given that the rates are going up and will go up further.
Okay, and we don't blame you for the cricket analogy, right? We all are in that mood today, bleed blue. That's what we all are talking about. But Mohit, of course, we have to continue speaking about mutual funds as well. While we can't decide what kind of ratio we should have for debt or equity, but do you really think we should make any big change, or the investors should make any big change to the MF's investment strategy at times like these? There is a lot of global uncertainty. We are in the upcycle right now, but we don't know how long will that stay.
Oh yes, I would rather say that the pitch conditions are not so conducive, so one needs to adjust the batting tempo accordingly, right? And having said which, I would say that I would try and distinguish between debt and equity allocations out here. First, I'll try and cover the equity portion. Look, equities are fairly expensive given the Indian market scenarios, and also that the rates are rising up, the risk premium on equity will increase gradually, which means that if your deposits move back towards 8%, 8.5%, the individual investor cannot be satisfied with a 12% return on equity. He will demand more and ask more, which will incrementally get difficult to generate given the valuations at which markets are currently. Right. So that portion of money can likely move back from equity to debt if the debt rates keep increasing. If deposits and fixed income securities become attractive, then money will move likely towards debt. So on the debt side, one can take two views out here. Either one keeps the money at the very short end of the curve, which is into ultra short instruments or money market instruments to avoid the interest rate risk, right? The yields have gotten fairly attractive out there. You are making almost YTMs of 6 to 6.5% at the short end of the curve. And the other view could be that my money is for fairly long term, which is, let's say, 3 years and beyond or 5 years and beyond, right? On those scenarios, one can consider target maturity funds, or which are also called as roll down funds, or they work more like open-ended FMPs. The interest rates or the YTMs out there are fairly attractive, again, within a band of around 7.5 to 8% depending on what tenor do you go for. But those are good instruments to take with a more likely scenario of getting those kind of yields and a good advantage of indexation as well on the tax front. So that's on the debt side. On the equity side, look, Sonal, I think again, I would rather say that if you want to take aggressive equity allocation, then go with large caps. Be in the cushion of large caps right now, because in times of any correction, large caps are the ones to bounce back the fastest and perhaps will give you some cushion to your portfolio because of the overall liquidity in the market on those stocks. And on a moderate side, I would recommend a balanced advantage fund or a multi-asset fund, which will give you a balanced flavor of both equity and debt. And the multi-asset could give you some additional comfort of getting in commodities as well on the portfolio side. So that'll be my current asset allocation or current changes in the portfolio. Sorry, depending on the way the markets are currently stacked up.
All right, got that. Mohit, but if I can just, go back to the debt equity mix that we were talking about. Yes, there cannot be a one-size-fits-all approach, but overall, if you can, just help our viewers understand, A, for someone who's looking at, say, a high-risk kind of profile. Second, if for someone who's looking at a more of a moderate kind of portfolio. And third, for a low risk. If you could just sort of break up what the equity and debt mix could look like in these three different scenarios.
Sure. I'll give it a shot, Pavitra, but again with a disclaimer that it is not one should not just blindly adopt it.
Yeah.
One should go and tweak it according to the personal situations and circumstances. But let's say for a high risk portfolio, currently the allocation could be 20 debt and 80 equity. And for a moderate risk portfolio, the allocation could currently be 60 in equity and 40 in debt, basically. And for a low risk portfolio, the allocation could be the reverse of high risk, which is 80 in debt and or 80 to 60 in debt and 40 to 20 in equity. Now, again, that last one, which is low risk, will depend as to how safely do you want to keep your capital and how much do you want to preserve it. If you're on the lowest spectrum, which is the most conservative, then go for 20 equity. But if you're fairly okay, then go for 40 equity. So that'll be my recommendation.
All right, Mohit, stay on. We have a lot more queries and questions coming your way. But for now, we'll quickly take a break. And on the other side, we'll answer all the viewers' queries as well. Stay tuned. Welcome back. You're still tuned into Mutual Fund Corner on CNBC TV 18, and we have with us Mr. Mohit Gang. And Mohit, as we told you, we have a lot of queries coming in from our viewers. So let's get that started now for you. Nikhil Khedkar, who's writing to us from Thane, he says, in the current rising interest rate scenario that we have been talking about, which type of debt mutual fund would provide him good return? And this, in addition to no undue risk of defaults as well. Mohit, what would you suggest?
Yes, Sonal. So look, Nikhil, I think if you're looking for a long-term allocation in debt, which is greater than 3 years, as I mentioned in the previous section, you could look at investing into target maturity funds or roll-down funds. Now, these work like open-ended FMPs. Virtually every other fund house is rolling out a new offer on these in this category every single day. There are few established ones also. I personally like the Edelweiss Bharat Bond series a lot. Absolutely high quality paper. You have options available right from 2025 maturity up till 2032 maturity, and you get indexation benefit also. And the yields are fairly high right now, within a band of around 7.5 to 798-ish, odd, roughly in this range, depending on which maturity will you choose. To my mind, it's an absolutely safe option if you can just buy and sit tight and hold till maturity.
All right, got that. Mohit, thanks for taking that. Another query that comes in, and this one is from Mukesh Kumar. He's written in to us from Delhi. The query is up on your screen, and he wants to know some mutual funds that he can invest in for a long-term horizon. He's actually been very specific and said 16 years. So, Mohit, that's a long period. Take us through some mutual funds that you would recommend, even if you're not naming a specific fund, just the kind that you would look at.
Perfect. I think he has a financial goal in mind, and that's why he's been very specific about 16 years. Look, for that kind of a long-term horizon, equity honestly is a very, very preferred asset class. If you can take the risk and bear the volatility, then go with a mix of a multi-cap and a flexi-cap fund out there, because the time horizon is fairly long, and that's why I'm recommending these two categories out here. Multi-cap because it will give you a good flavor of mid and small as well, and flexi because more often than not these days the flexi cap schemes are running like large cap funds only, with some small touch of or a dash of mid and small. They are like 70-75 odd % large caps. So you will have a good mix of large through the flexi, and you will have a good mix of mid and small through the multi-cap, and the portfolio will always remain very well diversified across these two categories. So that could be a very good allocation for 16 years.
Okay, so 16 years, a very well thought of time period as well. And as you said, it must be a dedicated goal for our viewer as well. To the next query now, we have Shweta Jain, who's writing to us from Chandigarh, and she is asking us if it is a good time to buy debt funds with least credit risk to target annual yield of around 8%. So there should be very limited downside to the valuations that she's talking about. And it is, of course, in the rising interest rate scenario that we are focusing on. Mohit, what would you suggest? It's a very definite return also that she's asking here.
Look, a little tricky, Sonal. Honestly, I think the expectation is still a little off what the current YTMs are in the portfolio. And let me also caution all the viewers out here that in a rising interest rate scenario, the more the long nature of the fund, which is the higher the modified duration or the maturity of the fund. So categories like income funds, medium-term funds, even dynamic bond funds to a large extent, they will deliver some amount of negative returns as interest rates keep going up. So a viewer has to be, or the investor has to be extremely cautious in terms of selecting the debt funds. Either you be at the extreme short end if you don't want the interest rate volatility in your portfolio. High credit quality is fairly doable if you buy a money market fund or a ultra short term fund. But the problem is the yields are not that attractive and you won't get that 8%. At the long end, then you have to go with target maturity funds, as I told you, but you have to sit tight and ride the interim volatility, because as interest rates move up, you will see some drawdown on your funds, or even on the debt funds, you will see negative returns, or you could see negative drawdowns. So investor has to be very cautious about that. But if you hold tight till the maturity, then a 775 kind of a return pre-tax is doable currently with the YTMs which are available in the market.
All right, I'm sure that will be very helpful for our viewer. Mohit, another query comes in. This is from Shashank Bharadwaj. He writes to us from Mumbai, and what he wants to know is whether arbitrage funds are a good option at a time like this. Would you recommend that?
Oh, yes, absolutely. If you are comfortable with the category, it's a great category to be in. Honestly, look, again, the play out there is more of tax efficient returns, because arbitrage as a category gets classified as equity, and the taxation is all equity. So, which means when you redeem short term, which is lesser than a year, then the taxation is only 15% short term capital gains, and which is a big leg up on what your debt taxation is, because debt gets clubbed in your marginal income and gets taxed at the marginal rate. So, rather than doing a short-term parking in a liquid fund or a money market fund, if you have a horizon of 3 to 6 months or greater than 6 months, then arbitrage could be a great category. It's just that investors have to read up a little on the category. It's not always as simple as it looks like, and it could be volatile. So it's not as stable and constant in terms of delivering returns as other debt categories like your liquid and money market. It could go up and down, but the current range of return again is around 5.5% give or take 50 bips. But being tax efficient, it is a good category to park money.
All right, arbitrage funds could prove to be a good category to park some money. Mohit, you know, another question that we get a lot from our viewers, especially the younger viewers, because you and I have spoken on Instagram as well, and that's where a lot of our young audience is just at times like this when there is so much volatility. We keep on talking about these big global risks. A lot of young investors want to know if perhaps they should wait a bit before getting into the market. You know, even if they can invest right now, should they put it off by a couple of months, wait for things to settle and then get in? Or you think it's just best to get in, and if you have a long-term horizon, it doesn't really matter too much?
Look, Pavitra, and you know my answer, and I think we
I know,
had
but
a
I have,
discussion roughly
yeah.
this. The best time to invest was yesterday, and today is perhaps the second best time. And I've always maintained that if you're
Yes.
sitting on cash, cash will never make you rich. Cash will only help you lose your money, given the way inflation is, right? So every single day spent sitting on cash is money lost.
Yeah.
Honestly, I think you could figure out ways and means to enter into equity. So I'm not saying just take a plunge right away, straight up. No good batsman will come and straight up start hitting sixes and boundaries. You need to pace your innings. And basically, so what you have to do is you have to get into equities gradually, either through an SIP mode or an STP mode, but you can't be out of the market. Look, markets have kind of defied every logic for last 1 to 2 years, right? Indian markets have just stood tall given the way global markets have behaved. Last 6 months have been a surprising rally in the markets when none was expecting it, right? So you can't be out of the markets. When you are out of the markets, you just lose a majority of the returns being out. So you have to be always in. Whether you are fully in, fully committed, all invested, or you are gradually entering is up to you and up to your liquidity and other situations. But I would rather recommend start dipping in gradually and start building your portfolio. And especially for young investors, if you're building for 20, 30 years, then there's no point waiting. Just get into the market and start knocking.
Okay, the time is now, or was yesterday, as Mohit is just telling us. So that takes me to the last question. Of course, we've discussed that as well in greater detail, but do you think this is the time to get into long-term gilts? Is there any specific fund that you would recommend for this particular product?
Sonal, this is a very, very technical question. Look, honestly, we can do a show, especially on games for a full 30 minutes, but I'll try and compress my answer out here. Honestly, if you are wary of interest rate risk and volatility on the debt funds, then it's not the time to get into gilts right now. Your 10-year is hovering around 7.5, basically, and given the way the interest rate scenario is globally and in India, rate hikes are on cards. The rates will further go up, and very likely that your 10-year will shoot past 8%, which has happened historically as well. If it shoots past 8, that's honestly, in my opinion, a great entry point to get into gilts. But when you are expecting it to happen so much, will it happen? When will it happen? Will it stay there for a longest time, or will it make other newer lows in terms of entering 8.5 and beyond kind of a territory? No one has an answer to that. But entering into gilts, which are long-term debt products, is perhaps most recommended when you see that level of 8 on the 10-year bonds. On the short end side, let's say if you are not that wary, you can bear volatility for 6 months in the debt fund, then I would rather recommend start dipping into gilts funds now. 7.5 to 7.6 is a good range. It's not the best of the range which you will get, but it's a good range to enter into this category. My one big recommendation out there would be a fund called Nippon Nivesh Fund. It's a very long dated gilt fund. They have maturities of 2043 and 44, 42, 43, 44 papers. So it's a very long maturity gilt, or you can buy a 10-year constant maturity gilt product from any of the mutual fund houses. But get in gradually. In next 6 months, you will get a great opportunity to make super money on gilts, and be ready with some cash to deploy if you see the level of 8% and above on the 10-year GSEC.
All right, and at that point, we will definitely ask you to come back on and, take you up on that offer for a full half hour on gilts. That will be interesting for our viewers as well. But Mohit, today we're going to leave it on that note. Thank you very much for joining us and taking out the time to answer all of our queries. We will let you get back to the match now. But remember, for our viewers, you guys can email us with all of your queries. You can write in on Twitter as well, and we will take them up with our experts on Mutual Fund Corner. Stay tuned. Closing bell is up next after this short break for the last hour of trade.